Now that a major recession has begun, economists would expect big retailers like Walmart to run into trouble as consumer spending dries up, and recent numbers show that's exactly what is happening. The giant superstore chain experienced its largest single-day decline in 35 years after an extremely disappointing earnings report was released. According to Forbes, the drop was so brutal that the Walton family lost $34 billion in 2 days. Adding fuel to the fire, a potentially weak holiday season and falling demand are threatening to spark even more losses for Walmart, but the retailer isn't alone. Many big companies are saying that inflation is eviscerating their profits and sales are going down far more rapidly than they've projected just a few months ago. Their woes are a reflection of an economy that is crumbling down in plain sight, and with economic activity contracting all across the board, businesses' struggles have only just begun. That's what we're going to expose today. Before moving on, please support our work with a thumbs up on this video and don't forget to subscribe. The last time Walmart saw such a wild market was on Friday, October the 16th, 1987, the last trading day before the infamous Black Monday, when shares of the superstore chain suffered their steepest one-day decline ever, crashing 11.7% in a single day. This year, right after releasing its fiscal report for 2023 earnings, shares of the world's biggest retailer plunged by 11.4% in a single day. At a first glance, the drop was marked by the most mundane of reasons. The company missed investors' earnings expectations, but other indicators show that this was just one element of a very bad year for Walmart stockholders. Bloomberg reported that the brick-and-mortar retailer suffered its worst stock decline in more than 35 years after predicting a drop in annual profit, underscoring the giant retailer's struggles to reignite growth, with earnings being revised downwards by 6.5% to 7.5% in the fiscal year. Investors expected the company to report a $1.48 per share profit, but Walmart instead reported $1.30 per share. While some may argue that the market is acting irrationally lately, Walmart's crashing stock price wasn't linked to the recent panic sell-off, but instead justified by an exceptionally weak performance. On top of disappointing earnings results, Walmart experienced a 24% decline in profits so far this year, according to Motley Fool's data. In the first quarter, the company earned 97 cents per share. By the end of the third quarter, that number dropped to 74 cents per share. Even after the dramatic stock market losses, the retailer is currently valued at a pricey 27.8 times trailing 12-month earnings. But given that Walmart is predicting that holiday sales in 2022 will decrease rather than increase compared to the same time last year, that high price-to-earnings ratio looks even more expensive and more volatility could be ahead. Forbes exposed that the Walton family saw its fortune drop by nearly $34 billion in only 2 days after its fiscal report was released. Jim, Rob, and Alice Walton, children of Walmart's founder, each lost roughly $9 billion, making them the hardest hit by the drop. Other Walton family members were affected by the decline, each losing more than $1 billion, it reported. Another worrying factor is that cash flow has been dishearteningly negative, with the retailer consuming $3.8 billion, spending $3.5 billion, and not generating any cash from operations at all this past quarter. Historical data from S&P Global Market Intelligence reveals that it's been nearly a decade since the last time Walmart suffered negative free cash flow of any amount, much less a grand total of $7.3 billion. And the retailer hadn't experienced negative cash from operations since Q3 1995, more than a quarter century ago. Its current 4% growth outlook is not impressing investors, who were expecting a 10% growth in the fourth quarter. Sales over the next few years will be critical for many retailers since they can often make or break a company's year. Experts say the 2022 holiday season is set to be an especially challenging one for many businesses because inflation and supply chain issues have put added pressure on retail companies throughout the entire year. As an industry leader, Walmart has dropped a big hint, suggesting that it does not think demand will be all that strong this holiday season. In September, the superstore chain announced it was hiring only 40,000 seasonal workers to help with the upcoming holiday demand, and that is in stark contrast to the more than 150,000 workers it added in the same period in 2021. This can aggravate many of Walmart's problems since its inventory levels are still at record highs, and even with the deep discounts it's offering as a result of trying to move all that inventory, the company still doesn't see consumer demand picking up, which should serve as a big red flag to investors. A lack of strong demand could force it to become more aggressive in discounting its merchandise, especially older items that are still taking up space. That would pinch its already small margins even further, explains Motley Fool's financial analyst David Yagaleski. Another thing that makes Walmart a risky stock to be holding today is that it trades at more than 27 times its trailing profits. Target, a retailer facing similar challenges, is trading at only 17 times earnings. With a tougher outlook ahead and potentially softer growth and profit numbers in the fourth quarter, Walmart stock could be due for a massive sell-off. For those reasons, I'd steer clear of it right now, he warns. Of course, it isn't just Walmart that's having trouble navigating through the current macro environment. With consumer confidence dropping by almost 20 points in October and inflation still impacting shoppers' habits, many businesses are showing signs of stress. For example, Walmart's smaller competitor Target also reported weaker than expected profits in its fiscal third quarter, citing an increasingly challenging environment. In the second quarter, Target's profit plunged 90% as a result of customers pulling back on purchasing non-essential items. The company warned that slowing sales and profit trends persisted into November, noting it should be prudent for investors to brace for considerable declines in comparable sales in quarter four. Consequently, Target shares fell 13.7% in early trading yesterday. In recent months, squeezed consumers had to shift more of their spending to higher-priced food and gasoline. That's why, just like Walmart, Target has been forced to cut prices on general merchandise, such as clothing, electronics, and home goods, because of a massive inventory glut. Several mall retailers, including Abercrombie & Fitch, American Eagle, and Gap, reported similar problems, with many of them also cutting their earnings forecasts. However, according to Target Chief Growth Officer Christina Hennington, the price cuts didn't help as much as expected. It finished the third quarter with 1.5% more inventory than it had 3 months earlier, and 36% more than it had a year ago. Even though the company said it reduced the amount of discretionary items it held in warehouses, Hennington noted the sales on those items put significant pressure on our near-term profitability. The executive said customers' price sensitivity intensified during the last 2 weeks of October. It was a precipitous decline, and frankly, we've seen those trends in the early part of November as well, she highlighted, adding that on top of everything else, the retailer is also seeing a higher level of shoplifting, which has jumped about 50% year over year. Those losses have had a more than a $400 million impact on Target's margins. Most of that has come from organized retail theft, Hennington disclosed. At the same time, logistics company FedEx recently reported its latest earnings numbers, and CEO Raj Subramaniam had a gloomy outlook for the near future. He warned that a global recession is on the way, telling CNBC that we're seeing that volume decline in every segment around the world. Another sign of distress comes from online retailer and Walmart's rival, Amazon. The company's latest efforts to boost its revenue may not pay off, and after stating that inflation is eviscerating its profits and sharing a bleak forecast for the holiday quarter, the e-commerce giant saw its shares falling by 19%. For the fourth quarter, the world's biggest online retailer forecasted net sales of between $140 and $148 billion. Analysts were expecting $155.15 billion. Early holiday marketing did little to boost sales growth, while labor and delivery expenses continue to swell, the company said. Despite reaching record highs during the pandemic, shares of Amazon have shed more than 40% in 2022 so far. A couple of days ago, the company also confirmed that it will start eliminating 10,000 jobs starting this week. Similarly, Facebook parent Meta recently announced 11,000 job cuts, the largest in the company's history. Twitter also announced widespread job cuts after new CEO Elon Musk said the company was operating at a loss for the past 4 quarters. In a sobering sign of the times, a growing number of business leaders, including Meta CEO Mark Zuckerberg to Twitter co-founder Jack Dorsey, have been issuing remorseful apologies in recent weeks as thousands of employees lose their livelihoods. Industry insiders say the wave of layoffs is likely to gain force in early 2023, and several indicators suggest they may be right. According to the findings of the president and CEO of Summers Capital Press, Graham Summers, industrial production fell for 4 months straight in the second half of 2022. This has never happened outside of a recession. Merchant wholesalers' sales are in recession territory. The Empire Manufacturing Survey is in recession territory. Furthermore, all 4 of the Fed's Purchasing Manager Index readings, that's PMI readings, Philadelphia, New York, Richmond, and Kansas City, came in at readings of sub-zero. This usually happens when you are already 4 to 5 months into a recession, he says. Another huge warning sign is the fact that month after month, fewer products are being shipped around the country compared to last year. If fewer goods are being shipped via trucks, rail, and air, is it a sign that the economy is, quote, strong as hell, unquote, as the government insists? Or is it a sign that this downturn is only intensifying? The answer, of course, is self-evident. A recent article by Wolf Richter notes that despite unprecedented fiscal stimulus during the pandemic, the economic boom generated by quantitative easing was extremely short-lived. Evidence keeps piling up in the most unpleasant manner that something isn't quite right in the real economy. We're now in an inexplicable slowdown. Despite 2 years of this huge monetary and fiscal stimulus, the economy is still deteriorating. And things have been crummy all year, with the exception of January and February. The shipping volume has been lower year over year every month. The index is broad. It tracks data from shippers no matter what carrier they choose, whether truck, rail, or air. Includes carriers like FedEx and UPS, he wrote. At this point, anyone telling the public that everything is just fine is either completely ignorant or they're purposely lying. When such a deceleration started taking place in 2008, Fed Chairman Ben Bernanke and the federal government went into full-blown denial mode. They kept telling Americans that the problems they were facing would soon fade away, but that just made things worse in the end. The same thing is happening now. But with the numbers that are popping up every day and the new reports showing that conditions are getting more and more difficult for businesses, it's impossible to deny that the next recession is here. Most Americans are already financially drained, and around 2/3 of U.S. households are saying they intend to tighten their belts and curb spending this holiday season. Needless to say, That will result in many more earnings disappointments and market losses in the final stretch of 2022 and well into 2023. Our economic scenario is looking very bleak right now. And what is happening to all of these major companies is just a hint of what smaller competitors will be forced to face in the coming weeks and months. The carnage is just getting started. The wise will take heed and make preparations, but the clueless will just keep on doing what they've been doing until it is far too late.